Welcome to Be the Boss of Your Money. I'm Mitch Goldberg. This is my live stream. It's all about personal finance, so you could gain the skills and the knowledge to better take control of your money. Today's live stream, today is all about preparing. Yes, we finally have a quiet day in the street. The stock market is actually all of a sudden boring in a good way. It's up. New record today for the S&P 500. But what we need to talk about is this: when times are good, prepare for times that'll be bad, which we all know are one day coming. Yes, I know if you are going to yell every day that the world is coming to an end, eventually you'll be right. However, we are talking about the stock market, which is known for its bust, its bull, its cycles, booms and busts. And we do know that when the market comes down, it could be terrifying for a lot of you. And we also know that it doesn't recover so quickly. And a lot of today's high flyers could get banged down so hard that they might not even recover. So we need to talk about what steps you could take. We also need to get an update on the latest news of the day, so you have the perspective to stay invested, stay your course, and stick to your plan. We'll roll a quick introduction. We've got a really good show coming up today. Here we go. Hi there, I'm Mitch Goldberg. Thank you so much for joining me. This is my live stream, Be the Boss of Your Money. I greatly appreciate your time. Your time is valuable, and it means a lot that you chose to spend some of it with me. I see a few of you out there, so while you're watching this, if you have any questions, you just want to give me a quick shout out, say hey, or if you have some words of wisdom or encouragement, they're all welcome here. I love hearing from you. Your questions are the best part of doing this. If you're watching in the replay, same thing applies to you. I will see your questions and I will certainly reply to you. Let's take a look at some of the action today in the market. It's been a busy week, lots of new highs, and it's being carried once again by the old standbys, by the FANG stocks: Facebook, Amazon, Apple, Netflix, Google, Microsoft. In particular, Google and Microsoft and Facebook, they have just been on fire lately. So we will take a look at these stocks and we'll take a look at a bunch of things. So the main thing today that I want to impress upon you by the end of this live stream is, are there things that you should be doing now because things are so good? I mean, while the getting is good, you want to make every penny of upside that you can in the stock market. You want to grab what's yours. You're taking the risk. You've stuck it out. You've toughed it out. You want to make sure that you're not just running away from the market every time it goes up. I mean, for the last 10 years, 11 years, how many times have you heard people scream out, no, the market's in a bubble, it's too high, it's in a bubble? And the advice has been wrong constantly to just sell everything because you're in a bubble. So let's get something straight. When you make decisions, or I should say, when I make decisions on behalf of my clients, because that's what I do. I'm a financial advisor, over 30 years experience, and I share the lessons and mistakes of both my experience and that of many clients over the decades. I share that with you so that you could be better at taking control of your money. What a great way to improve your life, right? Take control of your money. Don't let your money control you. So the most important thing is to let your personal finance guide your sell decisions. What do I mean by that? I simply mean that you have a time horizon to a goal. You have a child in high school going to college, you are retiring, you have a major purchase coming up, you're buying your first home. The money that you need for your near-term financial obligation, that should be out of the market. That is how you determine if you should sell something. Hey, I'm going to retire in 3 or 4 years. I'm pretty heavily in stocks. The market went up a lot. I'm even more heavily into stocks than I thought because the market went up so much in proportion to my fixed income and cash holdings, and maybe including my home, that I need to consider selling down my stock positions, putting that money into something stable like a money market, a savings account, other cash equivalents, so that the money is there when I need it. Because now it's not a matter of making money, it's a matter of preserving money, at least for that portion of your assets that you need for near-term financial obligations. That's what I mean by letting your personal finance be your guide. Now, if you're somebody you like to control things, and I'm not saying there's anything wrong with that, but if you're saying I'm in the market and I've got a long time horizon, but if the market's up too much, I do like to pull back a little bit and then I'll get back in at another time, and that's for you. We call that market timing. Then go right ahead. Or maybe you just want to scale back a little bit of your stock holdings. Just, it's up a lot. Your stocks have some big gains, and you're thinking it's smart to take something off the table. Plenty of stocks up over 100% in the last year. Plenty. And maybe you want to take something off the table. Nothing wrong with that. That's what this is all about. It's about your personal finance. It's about your risk tolerance. Now, I used to talk about, and I still do, about results-oriented investors and process-driven investors. Results-driven means that you are buying stocks, and then when they go up, you start to come off a little bit with your stocks. You take some off the table, and then maybe if stocks go down, you'll buy a little bit more. Not your whole portfolio, but with a portion of your portfolio, maybe a very small portion. And then you might see a stock that you've had your eye on for a long time. It goes down. Maybe you'll buy a little bit more, and you're managing your money. You're managing your investments. Process-driven is different. Process-driven means that you are simply investing every month into your blend of investments or mutual funds or exchange-traded funds, and somebody's going into large cap, small cap, mid cap, fixed income, international, cash, etc. And you're just doing that every pay period, month in, month out, and you're just going to let that ride. You're going to surrender the short-term outcome. So you're going to trust the process, surrender the outcome with the confidence that in 20, 25, 30 years, that is going to add up to a lot of money, that you're going to earn a return that keeps you ahead of inflation, and that is process-driven. And some people are a mix of both. Some people are mostly process-driven, a little results-driven, and vice versa. It's very important to know yourself. The most important thing to know about investing is not ratios and mathematics and how to read a balance sheet. The most important thing is to know yourself. That's big. That's deep. Know yourself. It's the most important thing. I see a few people out there, so I just want to say real quick, hey, Pete, thank you so much for the shout out, and so nice to see you. Thank you very much for joining me. Really appreciate it. Quick comment. Mitch, what are your thoughts to minimize capital gains from some of the great movers if I sell? Have had more than 3 years. My thoughts on minimizing capital gains are a few things. As a financial advisor, what I would say is this. You could contribute money to tax-sheltered accounts like a retirement plan, 401k, SEP IRA. You could do that for yourself. Your wife could do it, okay? And you as a realtor, you have some flexibility in terms of what you could do. That's one thing. The other thing is, if you have losses on other securities, take those. The number one reason people sell a stock is to break even. But if you have losses, you could sell those stocks to offset your gains. And maybe the ones that you took losses on, let's say, for example, you have a loss on an oil stock. Let's say you're down on ConocoPhillips, but you want to be in the space. You could flip that into Chevron Texaco. Does anyone call Chevron Texaco, or is it just me? Chevron. Okay. And what I like to say is upgrade on the downgrade. So when you have a stock that's down, you could sell it and buy a higher quality stock in the same sector. So those are just two ideas of what you could do. Other than that, my friend, congratulations on having such big capital gains taxes. That's what you're in it for. Okay, moving on. I see Josh is out there. Hey, Josh, how are you? Hey, I haven't seen you here for a long time. I'm so glad you joined me. I was actually thinking of you. And that time we were sitting together, you, me, and Amy at what's the name of that catering hall? Crest Hollow. It was like one of the last big events we were all together. That was so much fun. We laughed so hard. I can't wait to do that again. Nice to see you, my friend. So let's take a quick at the share screen. Couple of things, okay? And I want to bring some things into perspective. I've been pretty bulled up. I've made no secret that I think the economy now, it's in a boom phase. I have not kept that a secret, okay? I've been saying for a long time, the stock market, well, let me repeat that. I've been saying for a long time that the economy is in a boom cycle right now, booming. The only thing that I think economists got wrong is that they said, I agreed with this is my base case, about 9-10 months ago, that the economy would boom in the second half of 2021. I have it on tape. What's happening is that it's happening much sooner than expected, which is why you've gotten this incredible rally in the economically sensitive stocks like banks, industrials, energy, consumer discretionary, materials. So it's happening now. So if things are happening now, we've pulled a lot of demand forward with, I'm talking a lot with my hands today. I always talk with my hands. If we've pulled in a lot of demand forward, you have to wonder what kind of upside gains could we have? And you have to wonder and say, maybe I need to protect my assets because my investments have gone up so much that I'm thinking I have to control some of it. Look, I've been bulled up, but there are a lot of on the economy. And I've been bullish on the stock market. But as we all know, the stock market and the economy are two different things. That's why when the economy was doing so badly in 2020, the stock market was roaring higher. It's continued to go up in 2021. But we do have to think about some downside risks. So I just want to say this. As bullish as I've been, as positive as I am on the stock market, we still mustn't become complacent. We still always have to consider what could go wrong. Does that make me a negative Nelly? Nervous Nelly? No, I just think that I've been doing this for over 30 years, and I've seen really good economies and really good stock markets go really bad, really fast. We all have. Look what happened with COVID and the economy. So I want to make sure that we consider some downside. I want to make sure that we have a portfolio that we could live with. Now, you could say, well, I'm up a lot, and I'll eventually take some off the table. I'll eventually get to it. When I think the time is right, I'll sell a little bit. When things start to go down, I'll start to sell. That is the biggest mistake that you could make. That is completely undisciplined. You're probably never going to do it. And you're not going to be that one person who said, I knew it was going to plunge. I took everything out right at the top and I got back into everything right at the bottom. It's not going to be you. Okay. So let me tell you what to do and how this works. It's always a matter of rebalancing to me. Okay. If you're in individual stocks and individual stocks go up, enjoy the ride. Don't hesitate to take a little off the table on the way up. It's okay to hold some for the very long time. Everyone has those forever holdings. Yeah, I know nothing is forever, but I'm talking like I have stocks in individual clients' accounts, individual stocks and clients' accounts that have been there for 15 plus years, 20 years. Maybe we'll sell them one day, but we don't have as many shares today as we used to, unless the stocks come in and then you buy more, right? So there is a little bit of results process for me, and there's a little bit more. There's some results driven, and I'm mostly process driven, but there's a little bit of both. Like, there's a lot of process, a little results. How about that? Oh, that came off wrong. I have results. Come on. I mean, please. Okay. Hey, but I am also somewhat results driven. And I do believe that if a particular client's account is up way, way up, even with a long-term time horizon, it doesn't mean you have to do nothing. It doesn't mean you have to just say, I'm going to accept whatever comes my way. Maybe for that particular client, maybe you're 10 years older than when you originally started and you have to adjust your risk preferences. That's the sort of thing I'm talking about. So what do you do? Okay. I see a few of you out there in some comments, and I'm just going to get to those, but I want to keep the momentum going. All right. So you have to be aware of a couple of things. If you have high flying stocks, and this is the most important thing I'm going to say. If you have high flying stocks, a tech stock that has hugely benefited from the work from home, stay at home environment, if you have that, and that stock has a super high PE ratio, or if they don't even have a PE ratio, just a super high price to sales ratio, and that stock takes it on the chin because investors' preferences have shifted to cyclical, economically sensitive stocks, the odds of that high flyer recovering to where it is now could be very, very low. So you don't want to give back what you've made in that case. Now, maybe that stock comes right back up and goes even higher. And that's the thing. We don't know for sure. And that's why whether if I'm managing portfolios of individual stocks or exchange traded funds or mutual funds, there's something I do called rebalancing. And I reassess a client's risk. Now, if somebody said to me, I want to retire in 5 years, and they said that to me 5 years ago, already at that point, I am already in the process of gradually bringing down that client's risk metric. And that's what you should be doing, either on your own or with your financial advisor. So that's the most important thing is you're getting closer to a goal. You need to start scaling back on risk. And instead of worrying about getting a high return on your money, for that portion of money that you'll need, the worry becomes the return of your money. I hope that makes sense. Instead of worrying about a return on your money, you get to a point where you have to start worrying about a return of your money, especially when you have financial obligations coming up over the next couple of years. So that's what you really need to do. Now, as far as making portfolio changes, specific assets, you have to understand what's a reopening play and what's a cyclical play. Now, if you are a watcher of the show, if you recall, we went over every stock in the Dow Jones. Okay, I went over every single stock, all 30 of them, and I identified which ones are, in my opinion, which ones are reopening stay-at-home. No, I identified which are work-from-home, stay-at-home stocks, the screen stocks, that sort of thing, and which stocks are cyclical or economically sensitive that should do well because we expect the economy to go up. And the economy, make no mistake, the economy is doing very well right now. So let's take a look at some of the things that we need to watch. Do a quick share screen. Okay, I'll put myself up in the corner here. Hello there. Jeremy Siegel, the famous Wharton professor, says, enjoy the ride. Stocks could go up another 30% before this boom ends into the end of the year. So he's pretty optimistic for the rest of 2021. So we have to consider the upside. But everybody's different and everybody has a different level of risk. But then you see something like this. Researchers identify 5 new cases of double mutant COVID variant in California. Double mutant? I mean, it's kind of terrifying, isn't it? Double mutant. And it could make the current vaccines ineffective. Wow. I've been saying all along that I don't think a COVID surge slows the economy down because the right part of the population is being vaccinated, people over the age of 50, over the age of 60, over 70, et cetera. And so many people are becoming are getting vaccinated. So, and then we've got the double mutant. I mean, who wants double mutant? I mean, that's ugly stuff. So we have to consider that we do have a really bad surge. Now, what are we going to do? Lock down the economy? Can the Fed do another? And the government, can we get another stimulus package out? We could only get away with so many stimulus packages in 1 year. The Fed has printed 25% of all of annual GDP in 2020. So that's just in 2020. So I'm not even counting the $1.9 or $2 trillion stimulus plan that just came out since Biden became president. Doesn't include a potential infrastructure package as well. So we can't just keep doing these stimulus packages, okay? And that's one of the reasons why you're seeing tech stocks rally and, the stay-at-home work-from-home stocks, because there is a little bit of a shiver going down the spine of investors that says, maybe we're a little too optimistic on economically sensitive stocks, and we have to make sure we still stick with those tech stocks. If you want to know why the market went up based on tech stocks, and then we finally have, because they benefited from the shutdowns, well, shouldn't the market go down since those stocks go down? No, the many of the biggest stay-at-home work-from-home stocks have actually held their ground and are going up higher, like Facebook has been hitting highs and Microsoft has been hitting highs. Okay, let's take a quick look. The Dow today, I don't know if you could see that on your screen. Let me make that a little bigger. Dow up 57 points, NASDAQ up over 1%. See what I mean? The tech stocks up again. S&P up a little bit, new record, staying in the $4,000 range. Gold up. Gold is finally moving, and I think that basically is your signal that maybe someone's starting to worry a little bit about inflation. Not necessarily a bad thing, just that, hey, we are going to have some inflation, and it's about time we see gold start moving. I mean, lately it's been crypto that's been getting all the attention from investors as far as inflation. So it's about time we see gold go up, and you see technology stocks up 1.44%, consumer discretionary up a little, industrials. Overall, it was a pretty solid day. Look, I'm not saying get all negative. All I'm saying is that with the market up, instead of trying to time the top, what you could do now is start to scale out a little bit at a time and say to yourself, pick the number. I only want to be 80% stock, and maybe you're 95% stock. That means, and the other 5% could be cash or bonds. That means you've got to scale back stocks. You've got to decide where you should scale back. What are the opportunities that you could miss? And what are the disasters that you could avoid? So these are the things that you really need to do. As far as inflation hedges, if we get inflation, there's gold and there's energy. Those and real estate. Those are typically your publicly traded, available investments that typically do well in a rising inflation environment. I'm a little iffy on commercial real estate because of COVID and people working from home, but certainly gold and energy is still there. That's about it. I hope you have found this helpful. I know we had a couple people out there. Josh says, my second vax is scheduled for the end of April. Happy to hang anytime after, my friend. Same here. I got my second vax about 2.5 weeks ago. So I'm like, I was hoping I'd be vaccinated, but then I see double mutant and I'm like, what the heck is that? So we have Jay, just have diamond hands and pray. Hope is a strategy, right? Diamond hands. Do you know, folks, what diamond hands means? It's just Jay is very cool, so he knows that. I don't have. Oh, here it is. Okay, take a look at this. Let me take your comment off the screen, Jay, because it's blocking it. See this? Paper hands, diamond hands, tendies. People with paper hands just jump on whatever trend they could find. If a stock or a crypto is going down, they just sell immediately. They don't want anything to do with it. They get frightened out immediately. They're not long-term holders. They're weak hands, and they're always chasing the latest, hottest profit. That's why you have tendies on this one, on this girl here. Tendies is profits, gains. When I say gains, I'm talking about Gainz. So profits or gains in the world of Reddit, okay, is tendies. Paper hands are weak holders, and you see this one, diamond hands, and the girl's a diamond for a hand there, okay? That, my friends, means long-term holder no matter what. So that's what Jay is referring to. Be a diamond hand and just hang on through thick and thin. Now, listen, if you're 25, 35 years old and you don't need your money for 30 years, this particular episode becomes in some ways a lot less relevant to you. But if you are someone who says, I've made more money than I ever thought I could in the market, and I have these tech stocks that are up 300-400%, some of them, I don't know if we're ever going to see this again. And I don't know if these stocks are going to go get cut in half and I'm going to give back all that money. It's okay to make a move, take something off the table, reinvest in something else, get more diversification. Diversification is a strategy that is not meant for maximizing gains. It's a strategy that helps minimize risk, but it doesn't necessarily protect your portfolio overall from going down in a generally down market. Just want to make sure you understand diversification is not a foolproof strategy that protects your account from going down, but it could prevent your entire return from being overtaken by the worst performing investment that you have. And it could help your portfolio go down less in a down market, which means your portfolio could recover faster in a recovery. So there you go, folks. Thanks so much for watching. I will see you on Monday. Okay. I don't live stream on Fridays, but I do put out a kick-ass email. So if you'd like to get my email blast, the Friday blast, it's really good. And I'd love to share it with you. All my clients receive it. I've been sending you that for about 15 years now. All right. So you have a good one. If you think of anything that you wanted to ask me, remember, hit me up in the comments and I will be sure to see it. All right. Thank you.